Friends, in this session we will understand what is NPV. In business, when projects are taken, the investment is made to get returns out of it. Now these returns will be generated during the life of the project. Now a decision has to be taken whether to go with the project or not, but what parameters is available for us to take decision. It is basically the returns that is generated out of the project. Now when we say returns, what return should be looked into? It is only the cash flows that is generated out of the project should be looked into. So the cash flows would be basically the future cash flows which you are going to get in the future. How do we know what is the value of that cash flows now? So we have to calculate the present value of that cash flows, and that we will compare with the investment, and that exercise is called as calculating the net present value of the project. So NPV is nothing but identifying the future cash flows of the project and deriving its present value and comparing with the investment whether to go ahead with the project or not. So in NPV we will find the present value of cash outflows and the present value of cash inflows, and if the present value of cash inflows is greater than the present value of cash outflow, it is a positive NPV, and if the present value of cash outflow is greater than inflow, it is a negative NPV. So theoretical part we'll set aside. We'll see an example. Let's say we take up a project at a cost of 100, and this project is going to generate sales of 100. Whether this would make any sense? No. What is important is what is the returns that are generated from the project, and basically the cash flows that are generated from the project. So sales is not going to help us. We should look at the profit, and let's say the profit for every year is 30, and let's say the life of the project is 5 years. So there is a project at a cost of 100 and it's going to generate a profit of 30 every year for a period of 5 years. Now we have to find the present value of this profit over a period of 5 years. But what is more important is what is the expectation from this project? What is the expected return from this project? We'll analyze that in two scenarios. In scenario 1 you expect 10%, and in scenario 2 you expect 20%. So now we'll be able to study or understand NPV in a better way. Now we'll have the cash flows for all the 5 years. We'll start with year 0. Why it is year 0? Because that is the point where you commit all the cash outflows. So what is the cost of project here? It is 100. The cost of project is 100. So we'll put that 100 here. So it is shown in brackets because there is a cash outflow. Next we'll have all the inflows here. In year 1 there is going to be inflow of profit 30, so we'll have it here. In year 2 also it's going to be 30, year 3 30, year 4 and 5 30 each. So in all these 5 years this 30 was 150. So 150 has been earned out of this project. But on look it's going to tell you that you have invested 100 and this project is giving 150, so it's a good project because you have earned 50 more. But what is important is what is the expectation. Here the expectation is 10% in scenario 1, and in scenario 2 the expectation is 20%. So if your expectation is 10%, then the 1 rupee which you get today will not be equal to 1 rupee which you get after 1 year, because that 1 rupee could have earned 10% on that. So what I'm trying to say here is the cash flows which is happening in future will not have the same value today because they have return expectation attached to it. So this 30 which you are going to receive after 1 year is not equal to 30 which you are going to have today. So what we should do now? We should discount all these cash flows at the expected rate, which is 10%. So if you discount 1 rupee which is at 0.0 at 1 year, which is equal to 91 paise. So the 1 rupee which you get after 1 year will be equal to 91 paise. The 1 rupee which you will get after 2 years will be equal to 82 paise. After 3 years it will be 75, 68 and 62 paise. So here I have given the values directly without telling you how it should be calculated. But if you recollect, in time value of money chapter, we have calculated how to, or we have done an exercise how to compute the present value of cash flows. In that, this is explained how to compute the present value at these rates. So here the present value of 1 rupee at 10% after 1 year is 90 paise, 82 paise, 75, and it goes on. So now what I'm going to do is I will multiply this 30 which is going to be received after 1 year with this value. So that's going to be the present value. So I'll have it here, present value at 10%. For this 100 it's going to be same 100 because it is discounted at 1. But for 30 which we are going to receive after 1 year is not going to be 30. It will be 30 multiplied by 0.909. It is 27.27. So 30 rupees which is received after 1 year is equal to 27.27 today. And 30 rupees received after 2 years is equal to 24.78, and the list goes like this. So this is the money which is received over a period of 5 years. Now you look at the total. Total is 113. What was the money actually received? It is 150, but the present value of 150 is only 113. So now we can make some judgment, because the money taken out of this project is 113 and the investment is 100. So there is a positive inflow, right? There is a positive inflow to the extent of 13. So the NPV of this project is 13. It is not minus, it is hyphen. NPV of this project is 13. There is a positive NPV. But what would be the case if the return expected is 20%? Here we will be discounting at 20%, and the value which you get after 1 year will not be equal to 0.909, because 0.909 is for 10%. Probably for 20% it would be somewhere in the range of 0.825 or something. So at 20% discounting, the values would even come down or even come further. So we'll calculate PV at 20%. For 100 it's going to be same, but for 30 it's 25. So if you're expecting 25%, then if you get 30 after 1 year, it is equivalent to 25 now. And if you're going to get 30 after 2 years, it is equal to 21 now. And after 3 years it's equal to 17, 4 years it's equal to 14, and 5 years it's equal to 12. So the 5 years cash flow, which is 150, will be equivalent to the present value of 89. You have received 150, but its present value is 89 if you are expecting 20% return. So here your outflow was 100, whereas the inflow is 89. There is a negative NPV to the extent of 11. So what we have understood, we had two scenarios, scenario 1 and scenario 2. In both scenarios, investment was same 100, but there was a difference in return expected. In scenario 1 it was 10%, in scenario 2 it was 20%. And what is the gross value of cash flows in scenario 1 and 2? In both it was 150. But where the difference started is the present value. The present value in scenario 1 was 113. So that made it as a viable project, because there was a net benefit of 13, which is 113 minus 100. There was a net benefit of 13. But in case 2, the present value was 89. It was considered as a not viable project because there is a loss. Why there is a loss? Investment was 100, return or what is taken out is only 89. So 89 minus 100, there is 11 difference, and that is the loss for the people who have invested in the project. So NPV would tell you whether there is any net benefit in the project. Fine, this is a case where you had two expectations. You had an expectation of 10% and 20%. Let's say there are two mutually exclusive projects. In case of two mutually exclusive projects, we have to see the NPV of both the project. Let's say the project 1 has an NPV of 100 and project 2 has an NPV of 120. In this case, Both the projects are giving positive NPVs, then probably with which project we should be going? We should be going with the project which carries highest NPV. So only those projects will be selected. And one more important factor in NPV is this discount rate. We have used a discount rate, right? The expected return was used as a discount rate, the 10%, 20% example which we had. So the discount rate is basically the cost of capital, and again it should be weighted average cost of capital. Weighted average cost of capital will factor all the funds cost. So with that, with this discount rate, we actually factor the expectations of all the stakeholders. So expectations of all stakeholders are factored in discount rate.